Right, everyone, it is the weekend. This is when I like to do my COT report. If you are new to what the COT report is and these two groups that we refer to here, the asset managers and fund managers, I did do a video kind of introducing this and introducing the topic, talking about these two groups so that you'll have a better understanding of them. And if you was to search on the Bullish Bears YouTube for understanding the COT report or just COT report, it should pop up. So let's go ahead and get started. On Friday, the report came out. We are looking at the ES futures for asset managers. You can see that they took a significant portion of their position off this week. They not only closed out a lot of their longs, locking in gains, but they also decreased their hedge quite a bit, a quarter or nearly a quarter. When you add these two numbers together, that's how you can look at their entire change from September 20 to September 27. So as I wrote here, they took profits this week and significantly reduced their upside exposure. They are still considerably net long, though, above 800,000 contracts. It shows a real commitment to the continued reduction of their overall position because they've been working on it. In the chart below, we can see that the peak exposure from 2019, from way back here, had not been met when they began turning this thing around and heading back in the other direction. This is a 2-year chart showing the asset manager's positions. And when you look at it from this point of view, it really helps put things into perspectives. Yes, they are taking gains, and yes, they changed their position considerably this week, but we've seen bigger changes before. And one of the main takeaways is that they started to significantly reduce. You can see how they were kind of holding the line between June and July, and then it's all been downhill from here. They are just locking in gains, reducing that position, and they are continuing to do that. This is a zoomed in picture of leveraged funds from September 20 to the 27th. And what is notable is they are still net zero or net short. They're working towards zero. Leverage funds have significantly reduced their net short position. You can see that they're getting a lot closer to the zero line. They did that with nearly 83,000 contracts. While this reduction in net position, it is significant, right? You got to recognize that it is significant. It still leaves them short. Looking at a 2-year chart kind of brings it into perspective. Look at the size of the change this week. Now, we've seen big changes before, right? So it's not like some new thing that we've never seen. But when you think about, say, 2020, when we had the coronavirus and we rallied back out in March, they barely got to the zero line in that massive expansion coming out of March and into April. And that mega rally put them as close to zero as we can see in 2 years. And this week, they made significant progress towards getting to zero. Now, it is important to recognize they're always short, right? This is negative. They're always short in there. And when they actually come out of the negative and have a positive position, it's usually during the worst of a market environment, right? Or in the rally out of after a really negative environment. So if you think about the 2020 Corona crash, that was February, when we hit the lows in early March and then rallied back out, right? That is the whole move right in there. So in the current market conditions, we've had this weakness. We've been going down. Seems like they're locking in profits from that move to the downside. And if there is an expectation that the markets are going to start to rally, then we would expect in the next few weeks to see them reducing their position, going back into the negative. I don't know why they play it that way, but that's the fund managers. Okay, so looking at the grand scheme of those two charts, evaluating the S&P futures positions within the institutions suggests that there is a concerted effort to reposition before the end of the year. Now, this is something that we're going to touch on a little bit later, but we're in the fourth quarter. Leveraged funds have been net short in the S&P since late 2018, while asset managers have held above 800,000 contracts for the last 6 months and are signaling a new normal may be in play. In the coming weeks, watch that 800,000 level. It's going to give us clues about where the asset managers see risk, while watching the zero line will give us clues about leveraged funds. Historically, leveraged funds seem to position above zero in negative market conditions. During the COVID crisis, asset managers went from 1.23 million to 371,000, and they did that in 1 month, guys. 1 month. I'm talking about really reducing your position. These moves from the asset managers within the last 3 months look like profit taking, and that's really the distinction, right? Back in February of 2020, we saw what they could really do when they want to change their position significantly in a short period of time. This right here, what we've been seeing them do in the last few months, that's just them locking in gains. It really doesn't look like they're trying to bail out of the ship, right? So here's a zoomed in chart on the ES. We are in this descending wedge. There was some notable wick activity here, right, where we landed in some liquidity on each side. Look at the volume as well, right? That's 2 million contracts a day. All right, so now let's take a look at the NASDAQ. Asset managers this week reduced their position in the NASDAQ quite a bit. They took longs off the table, and they just slightly removed a little bit of that hedge. I mean, almost insignificant in the grand scheme of things. It mainly was the fact that they closed over 5,000 of their long positions. So they took a little bit of profit off the table. They're still sitting in a sizable position, though, over 25,000 contracts. Looking back over the last 2 years, they stayed positioned up to 60,000 and as low as, they went below zero a few times, right? During the virus mess, they got below zero and then rallied right back out of it as we came out of those March lows. And then in 2021, we went below zero there, but then rallied back out. So they've been kind of muted from where they were before the virus. They, got pretty aggressive in 2020, but through 2021, they've been really holding these low positions. Now, in the last few weeks, they went long, and now they're taking profit off the table. But if we look at fund managers, they're still in the hole. They're still negative. They got close to 10,000 and then started to increase again. Look at their long position. They took 5,000 longs off and added 6,000 short. When we add these two numbers together, they went short, or they increased their short position around 12,000 contracts. That's a pretty good size in a given week. When we try to put that in perspective on a larger chart, you can see the last 2 years here, where I like to just kind of glance at everything from the coronavirus perspective. So before the virus, they were marching along, doing really good, kind of tagging the edges or just popping above the zero line, and then the virus hit. And in that mega rally out of the virus, out of that March low, they got above zero and got close to 20,000. And then in September of 2020, they got very, very close to 20,000. And since then, they've been back below the zero line. Now, a few times It looked like they were going to get close to the zero and pulled back away from it. In 2 weeks, they went towards the zero and then substantially reversed their position. So it seems like there is this, they were hedging for a particular event, taking money off the table, right? Because they were short and they were locking in gains from those shorts. And now they're reloading their short positions. Fund managers seem to come above the zero line with their new position during times of market stress. Looking at the last 2 years of the chart, we can see that the COVID crisis was a period of time where they increased their position above zero. Now, recent weeks do look more like profit taking than anything else. While this week's report looks significant, you can see with the 2-year chart in that greater context that it's kind of normal for them in their positioning activity. While fund managers are increasing their short position, asset managers are decreasing their longs. It's noteworthy, guys. It is really noteworthy to recognize the activity used to accomplish this task, because the fund managers closed some longs and then they matched that with their new shorts at the same time, increasing the short position by more than 10,000 contracts. But asset managers, on the other hand, they just closed an equal number of longs while mostly maintaining their short, their hedge, causing them to hold a new position with significantly less risk, right? That's the main takeaway. They're getting risk out of the way, but they're not getting aggressive long or short. Here's a picture of the NASDAQ coming into that structure. Check the volume out, right? And then we've got also a descending wedge here. I did highlight some volume activity where we ran into, a liquidity pool. And notice the volume, right? When we tagged that low and rallied back up, we had that nice volume spike and then that decreasing volume in the rally. That's typical. It's normal. It's what we expect to see. Same thing here. We had an aggressive volume spike into the lows. And then as we rallied out of those lows, we had that decreasing volume. And we are positioning now again for, maybe the same move again. We got to see it unfold, right? So I don't normally do a full report on the Russell, and I'm not going to this week. But I am going to point out we've been in this range for about a year, just high to low, low to high, high to low. And yet look at the 2-year chart with asset managers, a 2-year chart, not a 1-year chart. So in 2021, asset managers have really just been taking money out of the Russell, just reducing nice and easy with no real aggression, just reducing their position. They're not to zero, not yet, but they're certainly working on it. And they don't seem very interested in doing anything else, right? Just nice, slow, steady decline. Now I'm bringing this up because fourth quarter, with capital rotation, fourth quarter considerations, I really think it's a good idea to just take a look at what's going on in the small caps and small companies. The Russell has maintained a solid base throughout the year. I mean, look at that chart. And the asset managers have just been pulling money out of that thing nice and easy, not wanting to rock the boat, right? They don't want to dump it. They don't want to spike it. They're just easing out nice and easy, no fuss. Now, when you bring it over and look at what the fund managers have been doing, look at 2021. We kind of tagged the lows, and in September, we seemed like we were heading in that direction, and then they really turned things around and have been coming back up again. But they're just maintaining that negative range, just nice and easy with them too. Since March, we really haven't seen a significant move in here, right? Okay, so with the Russell, it's not just that 9-month range that's causing concern, but the size of the candles. Look at the size of these candles here in the Russell. This is some pretty significant size, right? The ATR, the ADR, the candle close to candle close. It's significant. This week, asset managers increased their long positions by adding longs, but they also closed some of their short positions, which also increases their long, right? So they reduced their hedge in the Russell. I found that a little significant. fund managers not only increased their long position, they also decreased the total number of short contracts held, just barely, but still. Now, the fund managers are still net short by a good number, but they're slowly moving back into that minus 50 range. And that's kind of been their holding pattern for like 2 years now. This is some significant size on a day-to-day basis in the Russell. I mean, this is a really big, it doesn't seem like it because we've been seeing it all year long. But guys, you got to recognize the size of these moves in here. All right, the 10-year note in comparison to the ES futures. Now, I branched this thing out, went back to 2012, and I really wanted to highlight, look at the 10-year note between 2012, the later part of 2012, and the later part of 2014. Here's the S&P market, the ES futures, 2012 to 2014. Look at that run, right? We came out of 2012, really started to pick up steam, and we just ran all year, just a good hard grind to the upside before we kind of stabilized and went sideways. And look at that 10-year, staying below the zero line the whole time, right? And we're talking about the 10-year with these green and blue being two different institutions, right? Commercial and non-commercial. And then again in 2018, when the market just really started ripping and acting nuts, it went to the upside. And now we're significantly changing structure again. We're coming back below zero, right? So we're looking at a systemic change across the board. Look at how it split back here, right? We had that hard green move to the upside. We had that hard blue move to the downside. Well, what are we looking at right here, right? It's a game changer, guys. There is a systemic shift across the board. Asset changes in major ways, right? This isn't the subtle changes. This is mega changes. You can see the historical reference here. The US dollar. In this chart, it shows significant decisions were made at key periods in history. Now, again, guys, and I've stressed this before, I'm not an expert on the dollar. I don't have an economics degree. I don't have 30 years experience with the dollar. So if I want to look at the dollar, the only thing that I can do is just look back on the chart, right? But there were key periods in history that caused these significant changes. And I don't know what they are. I don't know what happened. It could be Brexit. It could be, you know, the 2017 elections. It could be a number of things that I don't understand, that I don't know, right? But we can see them. We can see when there was major economic changes in here. And that's what we're in right now. It's what we're in right now. So, you know, I want to point it out. I don't know what to do with it. I can't tell you what, you know, going forward, what this means for us. But we can look at these and we can go over to the ES chart and we can say, well, during that time period, what was the S&P doing? Or during this time period, you know, what was the NASDAQ doing? What were financials doing? What was technology doing? How did our market respond to these changes in the dollar? This isn't the forum for that, but I want to point out that there are some serious changes going on, right? It kind of reaffirms what I was pointing out with the 10-year. All right, so last week, what happened in the market? We're done with the COT report, by the way. So if that's what you were hitting on, you know, we've covered it. We're done and good to go. What I'm going to be doing now is kind of a quick review of what happened last week and then what we're going to be focused on next week. So last week's decline came as investors exerted caution into the end of the quarter amid concerns about inflation, supply chain disruptions, and continued pandemic impacts on economic growth. I want to call time out there and say, you know, there's been a lot of talk about the California coastline, all those boats sitting out there, those ships with cargo containers that need to be unloaded. They are still out there. We've got the debt ceiling. We've got Evergrande with bleed over contagion. We've got Bitcoin and China, stating policy on purchases with Bitcoin being illegal. So we got all of those things going on. Adding to the worries, the Federal Reserve has now started talking about a taper, and then from the taper, bringing in a rising interest rate within the next year. Right? So all of that is weighing on the marketplace. Despite rising prices, data released Friday shows consumer spending did rise in August, and it rose better than expected. It was only supposed to be 0.6. It rose by 0.8. And we've seen the response in the market Friday with that rally up, right? So that is a great improvement from July when we slipped. Investors were also encouraged by better than expected consumer spending data, especially heading into the holiday shopping season. And that's been a big deal too, because with those boats sitting off the port there in California, there's also a huge shipping crisis. We not only can't get the goods off the boat, but when we do, we don't have the truckers to run them. There's just a serious shortage in the shipping side as well. If we look at the sector performance on the week, energy dominated, right? And nothing else. Nothing else was even in the positive, but financials did try to come up. Now, remember that move in the dollar and in the 10-year. When it comes to financials, they're going to be greatly impacted by moves in the bond and the dollar. And apparently, the moves that we saw this week, finance didn't necessarily hate it because it's the closest thing to zero. It didn't get impacted as badly as a lot of other sectors did this week. Two main sectors on here that I watch is communication services and technology. And I kind of lump those two together a lot of times. Communication services didn't get hit as bad as technology, but technology got hit pretty hard. And technology responds to movements in the bond and the dollar because they're just addicted to lending, right? The majority of stocks have already been correcting. Many remain in corrective phases, even bearish market territory. Now, that's something that I've been discussing quite a bit lately. What is considered to be quote, quote, bear market territory? It's a 20% decline, depending on what institution you learn that from, or it could be a 10% decline. In this publication, they're using a 10% decline for correction territory and a 20% decline for a bear market territory. All right, so the chart below shows the percentage of stocks in the S&P that are down 10, 20, and 30% from their 52-week highs. So it's asking the question, how many companies are down more than 10%? How many are down more than 20%? How many are down more than 30% off of their 52-week highs? While many investors are waiting for a quote, quote, correction at the index level, you may be waiting for some time unless a more uniform attack on the mega caps name comes in. All right. So we really need those mega cap companies to turn around. So number of stocks down more than 10%, it significantly increased here in the last few weeks. Right. For the number of stocks down more than 20%, also a bump there. And then down more than 30%, not very many, right? And not much of a change. Now, seasonality is something that I've always found interesting, but I've never been comfortable with. Seasonality last week says that it's the weakest week in the year. It's an interesting concept, right? So the weakest week of the year since 1960. There's only been 1 year that had a positive week during that weakest week, if the 2 weeks before that were also red. And I know that may be a little convoluted, right? But just if last week is the one we're focused on, the 2 weeks leading up to last week, if they were red, then last week would be red. And it's been that way since 1960, with only one time that not working out. And last week proved yet again that if the 2 weeks leading up to the weakest week are red, then there's an expectation that the weakest week will also be red that week. And it was. On a personal note, me speaking from my own experience, in 2018, October, we went into a corrective market. And that was the first time as a trader that I had ever experienced such a thing. And it sticks with you when you get your first correction in the market. So during the month of October, I've put a lot of effort in my learning to kind of focus on the different quarters. And the fourth quarter sentiment by professional trading firms, street money, institutions, and how they kind of position themselves. It's game time. In the next 2 weeks, we're going to be looking for, market rocking events, which is a little bit about why I brought in the 10-year, why we looked at the Russell, why we looked at the dollar, and in this broader perspective. And I really wanted to point out the substantial changes in those charts because we're coming into game time in these next 2 weeks. If it starts to get nasty, it's going to get real nasty. And if it starts to get good, it's going to get real good. And it's going to just be blowing out to whole new levels or dropping down into really nasty territory. This is the time, by the way, in the next 2 weeks where I'm going to be significantly increasing my either or trades. And I don't do a lot of the either or trades because they take up a lot of buying power. But in an either or trade, if we rally, I make money. If we fall, I make money. If we stay in the middle, I don't make any money. So I don't really like to put them on a lot of times unless I am expecting some serious moves in the market. And I am. That's where we're at right now. I don't expect this wishy-washy market to hold out much longer. And I think we're going to start seeing a real shift where people get off the benches and start either putting that money back into play or really putting their money into some alternative assets. All right. Over the weekend, there has been some Tesla reports. They had really good numbers on their deliveries. That came out Saturday. Now, I'm not going to just sit here and read this whole thing about Tesla, but I will put this in the Bullish Bears Discord, and you can kind of peruse all of this Tesla data on your own. And I've got more Tesla data as I scroll down, but Tesla edged up a little bit higher. It's got a strong RS line. It's very healthy. It's at a buy point. It's just primed, right? We'll put it that way. And they reported some really good numbers. Netflix, Datadog, and Mosaic with American Express, Bill, Quanta Services, and PayX all have relative strength lines at the highs or very close to highs. And they are outperforming the S&P 500. So if we were in good market conditions, these would all be buying opportunities. But we're not. We're in a corrective market phase. So if you are looking at any of these thinking, oh yeah, maybe I'm going to get into them, kind of ease into it, guys. Be very cautious about opening new positions right now and just be quick to take that profit and shut that thing down if it looks like it's getting a little weak. Me, I'm going to be using the either or trades. So, I'm going to pile in and let them rip one direction or another. I don't care. Netflix is in a buy zone in a healthy market. Like I just said, this would be a buy, but we're not in a healthy market. That is a nice Busby, by the way. Also, Microsoft and Google, two mega cap companies, relative strength lines aren't that far from the highs. If Microsoft and Google can reclaim their 50-day lines, it'd be a real good deal for the NASDAQ. It needs a leg up. It needs a little bit of help at the moment. The infrastructure bill, this thing is still, being shaken around. $1.2 trillion is going to go, a long way. Now, they're still arguing about it. They're still, flipping the bird around, trying to figure out how they're going to land on this thing. Pelosi came out on Saturday and said it needs to pass well before October 31st. So, I don't know. They seem to set themselves some deadlines and, then they run right past it and set new deadlines. But we'll just be keeping our eye on that October 31st number. Also, last week, they did kick the can down the road into December They do need to deal with the debt limit. They've got October 18th as a likely government default date. Whew. Raising the debt limit without Republican votes could complicate the reconciliation package, and yeah, it's just a whole mess. Keep your eye on that data. There's no way to anticipate, when they're going to get it done, if they're going to get it done. So we're all just kind of sitting around watching news reports, waiting to see if a report comes out and says they got it done. IBD says the stock market rally attempted to begin again on Friday. Although last week we took some pretty heavy losses before that bounce Friday. Dow Jones 1.5 negative, S&P 2.2 negative, NASDAQ 3.2 negative, Russell 0.25% negative. Now they talk about the 10-year Treasury yield, which went up to 1.57% Tuesday morning, ended the week 1.46. The Friday 10-year yield retreat helped buoy the stocks at the end of the week. Now keep that in mind, right? When you're watching that 10-year on your intraday basis, or you're getting ready for your market in the morning, and take a look at that 10-year. If the 10-year falling helps the market right now, then you want to see on an intraday basis, is it moving up? Is it moving down? Is it moving towards support or away for support? Is it resting on a ledge and getting ready to break to new lows? Is it pressing against the ceiling and getting ready to break to new highs on the day? Because that's going to give you a good idea of what's going to happen to the market during the day. Growth stocks were hit hard last week. IBD 50 ETF, called the FFTY, plunged almost 9% last week. And their breakout ETF, called BOUT, that thing sank more than 4% last week. The IGV ETF, which I use daily, that thing sank more than 4% last week. But it holds a huge amount of Microsoft in that ETF, so not much of a surprise there. And then semiconductors got kicked in the face, minus 5.8% last week. Now, ARK with Kathy Woods, they have decreased their Tesla position significantly, but they are still in Tesla. Her ETFs went down last week as well, 5% and in one, and then almost 5% in the other. For the sectors, metals and mining were up. Infrastructure and development fell. U.S. global ETF JETS fell. Or excuse me, they went up. Right? So airlines are up. Infrastructure was down. Metals and mining was up. Energy was a huge boon last week. Energy shot up 5.8, and financials were off. And I say just slightly off too. Okay, so the major indexes suffered big losses last week. Now here's the significant part. The S&P 500 and the NASDAQ broke below the 50-day line and recent lows. They did rebound, but just one day, and it rebounded on very weak volume, especially in the NASDAQ. When we have volume and price elevated at the same time, it's a real good thing. But when we have price running to the upside and volume's not increasing at all, it's not very inspiring. If the major indexes avoid undercutting Friday's lows, we could have a follow-through day later this coming week or beyond. For now, we remain in a correction. We are in correction territory. The major indexes are below their 50-day and 21-day moving averages, but on the plus side, the Russell 2000 managed to regain the 10, 20, 50, and 200-day moving averages all in one day. Pretty significant. All right, so what should you be doing in the next week? Build the watch lists looking at the relative strength. Stocks like Netflix, Mosaic, Datadog, Paycheck, American Express, all of those have strong relative strength lines. Don't turn your back on any of the sectors just because you don't have, just because it doesn't have high valued growth stocks. Keep your eye on the market and let them point to you to the right direction. That statement is usually said a different way. Normally I say, when the sectors are doing good, look inside those sectors and trade the names that make up those sector ETFs. But when those sectors are not doing good, then we have to be stock pickers, and we don't look at the sectors to guide us. We go out and we hunt for names that don't make up those sectors. So I'll say it my way instead of their way. Here is the schedule for next week. This isn't as bad as it looks. I know it seems like we've got a lot of stuff on the table next week, but it's not that bad, right? This report came right out of Thinkorswim. You could just go to your Market Watch tab, bring it up, see what we got going on. Again, I'm not going to read all the Tesla stuff, but I've got a whole page here on Tesla's reporting and a little bit of discussion about LCID with that new car that they've got. Events in the spotlight for this coming week. General Motors has a 4-hour investor event. Serious, 4 hours. Now, usually when they have this event, they get a nice bump in their stock. They are going to be going into detail on the EV roadmap, financial goals. They're going to, try to comfort people down a little bit with their electric vehicle vision for the future. They're going to talk about the chip shortages. And yeah, it's on the table, right? But then we've also got IBM, Box, APPN, and GAN. They're also going to be having investor events this week. In that whole list of things in this picture up here where I showed the this year, and I said it's not that bad, there's really not a whole lot on here that we got to worry about. Well, these are the ones that we're going to really be looking at. It's the first full week of October, Q4. All eyes are going to be on employment data for the month that just ended. We're talking private sector September jobs data on Wednesday, looking at the ADP report. Then we're going to have the Labor Department's numbers on Thursday, and then we're going to have the U.S. non-farm payrolls and unemployment on Friday. So Wednesday, Thursday, Friday, jobs. You're going to hear it a lot this week. That's what I've got, guys. Sorry, it's a little longer than normal, but I thought it was, relevant. So that's what I got. Have a good week, and I will see you all next week.